Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome to the Deep Dive. Today, we're really getting into a crucial topic for anyone in business or finance: how companies handle, the really tough times like financial crises and recessions.
That's critical.
We want to explore how businesses manage to survive when everything seems to contract, revenue drops, credit gets tight. But also, how do some actually thrive?
Well, that's the thing. During these periods, corporate finance just fundamentally changes. It shifts.
Shifts how?
It goes from, let's say, long-term strategic planning to something much more immediate. Tactical, day-to-day survival becomes the focus.
Okay.
Your finance team, they effectively become the company's nerve center. They're constantly stress testing financial models, watching liquidity like a hawk, renegotiating terms, reassessing capital access.
Non-stop.
Pretty much. So our mission here is to pull out the key insights from real-world cases and expert analysis on how finance teams navigate these incredibly turbulent waters.
Okay, let's unpack that shift a bit more. For a CFO, say, during a crisis, it sounds like their whole world flips upside down.
It really does.
Weekly meetings suddenly become daily stand-ups, budgets getting reforecasted constantly.
Oh, absolutely. Sometimes multiple times a day. And the whole language changes, right? Growth is out, survival is in, everything gets tested.
Like what specifically? What gets put under the microscope?
Well, the company's capital structure, for one. How much debt versus equity do they have? How flexible is their cost base? Can they actually cut expenses quickly?
And leadership, too, I imagine.
Definitely leadership resilience. And look, finance people in these moments, they're not just crunching numbers. They really become sort of business architects.
Architects. Explain that.
They're making the hard trade-offs in real time. Things like, do we defer this big capital project? Can we renegotiate our leases? Do we freeze hiring? Or worse, do we need to restructure our debt?
So their priorities become laser-focused.
Exactly. Number one, preserve liquidity. Keep the cash flowing. 2, cut costs aggressively but smartly. 3, recalibrate those revenue forecasts constantly. 4, maybe restructure capital. And 5, keep everyone in the loop: stakeholders, investors, employees, constant communication.
That makes sense. It's those real-time decisions that matter.
Every single one.
Okay, so this is where the case studies come in, right? Seeing how this plays out in reality. We've got some examples.
We do. And they show really different approaches, different outcomes. It's fascinating.
Let's start with maybe the ideal scenario, the ones who were ready.
Right. The gold standard for being prepared has to be Ford, back in 2008.
Yes, the automaker that didn't need the bailout.
Exactly. How?
Yeah.
Well, they secured a massive $23 billion line of credit before the recession actually hit hard.
Before, that's foresight.
Incredible foresight.
Yeah.
Their CFO and the finance team prioritized getting that liquidity locked down, refinancing things while the credit markets were still, relatively open.
So when the crisis hit, they had a cushion.
A huge one. It allowed them to avoid bankruptcy, unlike GM and Chrysler. It wasn't luck. It was a very deliberate, very early strategic move.
Okay, so Ford planned ahead. But what about shocks that nobody sees coming? Like the pandemic. You can't exactly plan years ahead for that kind of shutdown.
That's a great point. And that's where you see a different kind of financial skill emerge. Creative financing under extreme pressure. Delta Airlines during COVID is a perfect case.
Right. Airlines were hit incredibly hard.
Unimaginably. Delta saw, a 90% drop in passengers almost overnight in 2020.
90%? How do you even survive that?
Well, first, drastic cost cutting. They slashed operating expenses by over half. But the really clever part was raising cash. They raised over $16 billion.
$13 billion? How?
Using asset-backed bonds secured by their loyalty program, SkyMiles. Basically, borrowing against the value of future customer loyalty, plus some equity, other loans.
Wow, using the loyalty program as collateral.
Yeah, really innovative stuff led by their finance, treasury, and FP&A teams, financial planning and analysis. It shows you need creativity, not just caution.
Okay, so we have proactive planning with Ford, creative financing with Delta. What about companies that maybe went into a crisis already a bit overextended?
Good question. Starbucks around 2008 fits that description. They had expanded, frankly, too quickly before the recession.
I remember they were opening stores everywhere.
They were. So the crisis forced a reckoning. They had to make painful choices.
Hmm.
Closed over 600 stores, significantly restructured operations, and put a laser focus on cash discipline.
And Howard Schultz came back as CEO around then.
He did. He refocused the whole strategy back onto core efficiency, the customer experience in the stores. It was a strategic retrenchment. Painful, yes, but they emerged leaner, stronger, with better margins.
Closing 600 stores, that means job losses, huge disruption. There's a human side to all this financial maneuvering.
Absolutely, and how leaders handle that communication is crucial. Think about Airbnb during COVID.
Another company facing near zero revenue.
Exactly. Bookings just evaporated. CEO Brian Chesky had to cut 25% of the workforce, scale back big plans. But the key was how he did it.
What was different?
Very clear, very empathetic communication. He was transparent about the reasons, acknowledged the pain, and tried to support departing employees. That maintained a level of trust internally and with investors.
That seems rare, unfortunately.
It can be. But it helped them pivot, too. They quickly shifted focus to domestic travel, longer-term stays, adapting to the new reality. It shows leadership isn't just strategy. It's also empathy, especially in crisis.
That pivot you mentioned, that flexibility, it makes me wonder, were there companies that actually, grew or expanded during these crises, went against the grain?
Oh, definitely. Amazon during the pandemic is the obvious example.
Right, while everyone else was cutting back.
Amazon was hiring hundreds of thousands of people. They massively reallocated resources, ramped up their supply chain to meet that surge in online demand for everything.
So their finance team wasn't focused on cutting, but on funding expansion.
Precisely. Quickly reforecasting logistics costs, figuring out investment levels needed for that surge. It showed incredible operational and capital flexibility at a massive scale. They leaned into the crisis.
We've seen resilience, creativity, flexibility, but it doesn't always work out. There must be cautionary tales too.
Sadly, yes. JCPenney during COVID is a stark one.
They were struggling before the pandemic, weren't they?
They were. High debt, falling sales for years. So when the pandemic hit and forced store closures, they just didn't have the resources.
Not enough liquidity.
Exactly. Not enough liquidity, not enough capital flexibility. They filed for bankruptcy in May 2020. It's a harsh lesson. A weak balance sheet heading into a storm makes survival incredibly difficult. You can't easily fix fundamental issues mid-crisis.
Like trying to patch a ship in a hurricane, as you said.
Right. And sometimes the situation is so severe, external forces step in.
Like government intervention.
Yes. General Motors, back in 2008, 2009. They filed for bankruptcy in June 2009, and the government stepped in significantly to restructure the company.
A massive overhaul.
Complete overhaul, huge debt reduction, major cost restructuring, led by Treasury and FP&A teams working with the government task force. It permanently changed GM's capital structure and cost base. It was a reset, but not entirely on their own terms.
Okay, so we've covered a lot of ground here. Ford's foresight, Delta's creativity, Starbucks' refocus, Airbnb's empathy, Amazon's agility, and then the struggles of Penny and GM. If you boil it all down, what are the common threads, the key strategies that emerge?
Well, several things stand out. One is implementing, or at least being ready to implement, zero-based budgeting.
Meaning you justify every dollar spent every time?
Exactly. Instead of just adjusting last year's numbers, it forces a really fundamental look at where money is going and whether it still makes sense. It can uncover savings even in good times.
Makes sense. What else?
Building multiple scenario models, not just best case, worst case, but a range of plausible futures. What if revenue drops 20%? What if it drops 40%? What levers do we pull in each case?
Planning for different levels of bad news.
Right. And related to that, refinancing debt before things get tight, like Ford did. Don't wait until you're desperate and credit markets seize up.
Proactive financial management.
Absolutely. And maintaining operational flexibility. Can you shift resources? Can you adjust production? Can you renegotiate contracts? That agility is key.
Like Amazon shifting to meet demand.
Precisely. And crucially, communicate early and often with everyone, board, employees, lenders, suppliers, customers. Transparency builds trust, even when the news is bad.
So for the finance team specifically,
They need to be all over liquidity daily monitoring. Super close relationship with the CEO and board. Using that real-time scenario planning. Watching credit markets and government policy like a hawk.
and leading conversations across the business.
Yes, confidently leading those cross-functional discussions. They need to master cash flow, know their debt covenants, those loan agreement clauses inside out, communicate clearly, and forecast with flexibility. It's a demanding role.
So wrapping this up, the core message seems to be, Crises are unavoidable, they will happen. But how prepared you are, how agile you can be, and the quality of your financial leadership, that's what determines if you just survive or if you potentially come out stronger.
Exactly. It's a test, but also an opportunity to reset and refocus, which leads to maybe final thought for you, the listener.
Up for it.
Recessions, crises, they come and go. The leaders, the companies, even individuals who navigate them best are the ones who stay prepared, who act with clarity and adaptability when things get tough. So the question becomes, what does this mean for your approach? How do you think about stability, resilience, strategic thinking in your own context, whether that's your business, your team, or even managing your personal resources? How can you apply these principles of preparedness and agility? Something to consider.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.